Good morning, everyone. As we head into the weekend, the U.S. markets are, of course, closed. We are looking at the final figures from Friday, November 7th, 2025 for Rezolve AI, ticker RZLV. The stock finished the session at $3.83, down just 2 cents for the day, or about 0.5%. But that flatline close hides what was actually a very volatile session. The stock opened lower at $3.64, dipped to a low of $3.57, and then rallied all the way to $3.93 before fading into the close. This was on 9.9 million shares of volume, which is notably lower than its 30-day average of over 22 million. Now, the first thing that should jump out to anyone looking at this company is the staggering disconnect between that $3.83 price tag and where Wall Street analysts believe it should be. The consensus analyst rating is a strong buy, with an average price target hovering around $9 and some targets stretching as high as $10.79. That implies a potential upside of over 150% from where it just closed. This isn't just a small gap, it's a canyon, and understanding why that canyon exists is the entire story of this stock. The expectation is that this is a disruptive force. The reality, at least for now, is that the market is deeply skeptical and pricing it for failure, not for success. Let's first establish the expectation, the narrative that has drawn so many traders to this name. If you've been doing any online investing or looking for the next big AI play on your Robinhood app, you've likely seen the story. Rezolve AI is being positioned as a leader in what it calls Agentic Commerce. This is the idea of moving beyond simple chatbots to AI agents that can actually do things for you. Understand a photo of an outfit, find the products, and complete the purchase. The company has a proprietary large language model called BrainPower and a brain suite of products for B2B retail clients. The narrative got a massive boost from reports that Amazon's own CEO has called this type of agentic interaction the future of e-commerce. When you hear that, you're not thinking about a $3 stock. You're thinking about the next NVIDIA stock or a disruptive force that could one day rival the giants. This is the story that caused RZLV to rocket from its 52-week low of $1.07 to a high of $8.45. It's the promise of exponential growth, and it's what's fueling the strong buy ratings. Now, let's slam into the reality, which is what the trading action of the last 6 weeks is telling us. On October 1st, Rezolve reported its latest earnings. On the surface, it looked okay. Earnings per share of -3 cents actually matched estimates. But the big number, revenue, came in at $4.88, a significant miss from the $6.75 the street was expecting. In a bizarre twist, the stock initially exploded higher, peaking at a 25% gain that day. Why? Because management didn't just meet expectations, they raised their guidance, projecting they would hit at least $150 million in annual recurring revenue, ARR, by the end of this year, up from the $90 million they had year to date. The market for a day bought the story, and then it stopped. Since that earnings report, the stock has bled out, falling over 24%. The excitement over the $150 million promise has been completely overshadowed by the reality of the $4.88 in actuals. The market is effectively calling their bluff. It's saying, we don't believe you can get there. This is where the recent stock movement becomes so critical to analyze. That post-earnings slide tells us that institutional confidence is weak. While the story is perfect for a quick Robinhood stock trading flip, the larger players who use interactive brokers or manage Fidelity wealth management accounts are looking at the balance sheet, and what they see is concerning. In the quarter ending in June, the company posted a net loss of $28.93 million on revenue that was just a fraction of that. The company has negative total equity of over $14 million. This is a business that is burning through cash at an alarming rate. Analysts who are bearish on the name point to these figures, as well as a low current ratio of 0.22, which suggests potential liquidity issues. They also note that the company's own 2025 revenue forecasts were reduced due to delays in customer deployments. That is the reality that is keeping the stock pinned under $4. It's the fear that this company, for all its potential, may simply run out of cash before its future of e-commerce arrives. Let's look at Friday's trading again. The volume, as noted, was low, less than half its recent average. This can be interpreted in two ways. The bearish take is that all the buyers have vanished. The buy-the-dip crowd that uses SoFi Invest or other investing sites have been burned too many times on the way down from $8. The bullish take is the selling pressure is finally exhausted. The stock hit $3.57 and found a floor, with buyers stepping in to defend that level. The rally to $3.93 shows there is still interest, but the fade into the close shows the sellers are still in control. This is a stock in a technical downtrend, and it has broken through all its major moving averages. It's in no man's land, trading purely on sentiment. This is not the kind of stock you add to a diversified, long-term, intelligent portfolio. This is a high-risk, speculative investment. So who exactly is buying and selling? The ownership data is fascinating. According to NASDAQ, 101 institutions own the stock. This isn't just a retail-only name. We're talking about BlackRock, Vanguard, State Street, and even Charles Schwab Investment Management, Inc. They all have positions. And in the most recent filings, 74 of those institutions increased their positions, versus only 20 that decreased. This tells us that some of the smart money is, in fact, nibbling. They are likely building small, speculative positions through their individual brokerage accounts. However, the total institutional ownership is still very low, sitting at around 25 to 30%. The vast majority of the float, over 70%, is held by the public and retail investors. This explains the extreme volatility. When you have a high retail interest stock, you get these massive swings based on headlines. It's a battle between the professional Fidelity trading platform users who are analyzing the cash burn and the SoFi active investing crowd who are trading the Agentic Commerce narrative. It's important to quickly clarify what this company actually does. Rezolve AI, RZLV, is a public B2B SaaS company for e-commerce. It should not be confused with a separate and private company called Rezolve AI, which focuses on internal IT help desks. RZLV is purely focused on retail. Their Brain Suite is designed to be integrated into a brand's mobile app or website. The idea is that a customer can take a picture of a product and the AI will recognize it and allow an instant purchase. It's about collapsing the sales funnel from discovery to checkout. This is why it gets lumped in with the broader AI hype, even though it has nothing to do with the business models of Tesla stock or Apple stock. It's a pure software play, which is why it's found its way into Fidelity mutual funds and ETFs that focus on small cap tech and generative AI. This brings us to the future outlook and that core tension between expectation and reality. The entire bull versus bear case hinges on one thing, that $150 million ARR target. If Rezolve AI somehow hits that number by the end of this year, or even comes close, this stock is not just cheap, it is ridiculously, absurdly undervalued at $3.83. The short sellers will be forced to cover, the institutions will pile in, and the stock will move towards those $10 analyst targets so fast it will look like a rocket. This is the dream for the self-investing crowd, finding that micro-cap that becomes a 10-bagger. This is the investment help everyone is looking for. But the bear case is just as powerful. The reality is that their quarterly revenue was under $5 million. To get to a $150 million annual recurring run rate implies a level of growth that is almost unheard of. The market is pricing in the high probability that they miss this target and miss it badly. If that happens and the cash burn continues, the next step is almost certainly a capital raise. They will have to sell more shares to fund operations, and that dilution will crush the stock price, likely sending it right back down towards its $1.07 low. This is the nightmare for anyone holding Robinhood fractional shares and hoping for a quick rebound. So as we look ahead, the path is entirely binary. The market is waiting for proof. The narrative is fantastic. The technology sounds impressive. But the numbers, the actual reported financials, are terrible. The company has given itself a high bar to clear. Friday's low-volume churn at $3.83 is the market in a holding pattern, waiting for the next piece of news, waiting for a sign that the $150 million target is real or a sign that it was just a fantasy. This is a stock that truly tests an investor's conviction. Looking at this chart, RZLV has been all over the place. Comment below if you think Rezolve AI will hit